You walk into your bank, deposit your paycheck, and walk out feeling safe. But what if that feeling is the biggest lie in modern finance? Most people grow up believing that a bank account is the foundation of financial success. From the first paycheck, the message is clear. Deposit your money, keep it safe, and let it grow over time. This belief feels logical because banks present themselves as guardians of stability. They use language that implies progress and security, reinforcing the idea that responsible adults store their money in savings accounts and trust the system to reward patience. The problem is that this belief quietly blurs the line between preserving money and building wealth. Two concepts that are fundamentally different. A bank account is designed to protect money from loss and make it easy to access. It allows bills to be paid, emergencies to be handled, and transactions to happen smoothly. In that sense, it performs its role extremely well. What it does not do is meaningfully increase purchasing power over time. While many people see interest payments as proof of growth, those numbers only tell part of the story. The real measure of financial progress is not how many dollars sit in an account, but what those dollars can buy. When inflation rises faster than interest, money may look stable on paper while quietly losing real value. This is where the illusion begins. Savings accounts typically offer very low interest rates, often well below the average rate of inflation. Each year, prices for housing, food, healthcare, and education rise. Even small annual increases compound over time. When money earns less than inflation, its purchasing power declines. The account balance stays the same or increases slightly, but its ability to support future needs shrinks. This slow erosion is difficult to notice because it happens gradually. But over years and decades, it creates a significant gap between perceived security and actual financial strength. Banks are fully aware of this dynamic. Savings and checking accounts are not built to create wealth because wealth creation requires exposure to growth and risk. Banks avoid risk on deposits because their priority is stability and liquidity. They need to ensure customers can withdraw money at any time and that accounts remain predictable. Growth-oriented assets do not offer that guarantee. As a result, banks position deposit accounts as safe and responsible, knowing that safety comes at the cost of long-term growth. The marketing around banking reinforces this misunderstanding. Phrases like, "Watch your savings grow," or "Secure your future," suggest progress without explaining the limitations. The focus remains on nominal numbers rather than real value. This allows customers to feel financially responsible while unknowingly falling behind. The system does not require deception. It only requires omission. By not emphasizing inflation or opportunity cost, banks allow people to assume their money is doing more than it actually is. Another factor that strengthens this illusion is emotional comfort. Cash in the bank feels tangible and reassuring. Seeing a balance provides a sense of control and certainty that fluctuating investments do not. This emotional security can become addictive, encouraging people to keep more money in low-yield accounts than they truly need. Over time, this habit trades long-term progress for short-term peace of mind, often without conscious awareness of the cost. The distinction between money storage and wealth building becomes critical over long-time horizons. Money meant for short-term needs belongs in bank accounts because accessibility matters. Money intended to support future purchasing power requires growth that outpaces inflation. Confusing these two purposes leads to financial stagnation. People may save diligently for decades and still find themselves unable to maintain their lifestyle later in life. Not because they failed to save, but because they relied on tools that were never designed for that goal. Understanding this reality changes how financial systems are viewed. Banks are not failing their customers. They are performing exactly as designed. The misunderstanding lies in expectations. When people expect banks to grow wealth, disappointment and frustration follow. When banks are recognized as storage and transaction tools rather than growth engines, clarity replaces confusion. Wealth is not built by where money is parked, but by how it is allowed to work over time. When most people deposit money into a bank, they believe it simply sits there, waiting patiently until they need it. The balance on the screen feels like ownership in its purest form, a digital vault holding cash on their behalf. In reality, The moment money enters the banking system, its role changes completely. It stops being idle and becomes an active tool for the bank to generate profit. This transformation happens quietly, without explicit consent or awareness, and it forms the core of how modern banking operates. A bank deposit is not the same as storing cash in a safe. Legally and functionally, it is closer to issuing a loan to the bank. Once money is deposited, the bank is free to use it for its own purposes, with the obligation to return it when requested. The depositor becomes a creditor, not a custodian, and the bank becomes the borrower. This distinction is rarely emphasized because it contradicts the comforting narrative of safekeeping. Yet it is fundamental to understanding how banks make money. The primary way banks profit from deposits is by lending them out at higher interest rates. While depositors receive little to no interest, borrowers pay significantly more for access to that same capital. Mortgages, car loans, business loans, and personal credit all originate from this pool of deposited funds. The spread between what banks pay depositors and what they charge borrowers is called the net interest margin, and it represents one of the largest sources of bank revenue. This margin exists because depositors accept minimal compensation in exchange for perceived safety and convenience. What makes this system even more powerful is that banks do not simply lend out the money they receive. Through fractional reserve banking, they create new money in the process of lending. When a bank issues a loan, it does not transfer existing funds from one account to another. Instead, it creates a new deposit in the borrower's account while the original depositor's balance remains unchanged. This process expands the total amount of money in circulation, allowing banks to multiply the impact of each deposit. This mechanism feels counterintuitive because it challenges the idea that money is a fixed quantity being moved around. In practice, bank lending increases the money supply, and deposits act as the foundation for that expansion. Each loan creates new spending power, which then circulates through the economy and often returns to the banking system as additional deposits. The cycle repeats, amplifying the original deposit far beyond its initial value. While this process is regulated, it remains largely invisible to the average account holder. The system relies heavily on trust. Depositors assume their money will be available when needed, even though only a small fraction of total deposits exists as physical reserves at any given time. As long as withdrawals remain predictable and confidence stays intact, the system functions smoothly. Banks depend on the fact that not everyone will demand their money simultaneously. This confidence allows banks to operate efficiently, but it also highlights how deeply psychological the financial system truly is. For depositors, the implications are significant. Their money is actively working, but not for them. It is generating income for the bank, funding loans, and supporting economic activity, while providing the depositor with minimal return. The safety and convenience offered by banks are real, but they come at the cost of opportunity. The value extracted from deposits flows upward to institutions and borrowers who can leverage capital more effectively. This does not mean the system is inherently unfair or deceptive. Modern economies depend on this structure to function. Without deposit-based lending, access to credit would shrink and economic growth would slow dramatically. The issue lies in misunderstanding. When people believe their deposits are growing wealth, they misinterpret the role those funds actually play. Banks benefit from this confusion because it allows them to secure inexpensive capital while maintaining a reputation for stability and trust. Recognizing deposits as loans rather than storage changes the relationship with money. It reveals why banks prioritize attracting deposits, why interest paid to savers remains low, and why lending products are aggressively marketed. Deposits are not passive balances. They are raw material. Understanding this reality removes the illusion of inactivity and exposes the true engine behind banking profits. Credit cards appear harmless on the surface. They are presented as convenient tools, safety nets for emergencies, and even sources of rewards that seem to pay you for spending money. The plastic card in your wallet feels like freedom, a way to smooth out cash flow and handle purchases without friction. Beneath that polished image, however, credit cards represent one of the most profitable and strategically engineered products in the entire banking system. designed to extract maximum value from human behavior rather than financial logic. At their core, credit cards are unsecured loans. Unlike a mortgage or a car loan, there is no house or vehicle backing the debt, because the bank has no physical asset to seize if you fail to pay. It compensates by charging extremely high interest rates. These rates are not random or excessive by accident. They are carefully calculated based on risk, behavior patterns, and statistical models that predict how long you will carry a balance. The interest charged is the price of uncertainty, and the bank prices that uncertainty aggressively. What most people do not realize is that banks categorize credit card users very differently depending on how they behave. Those who pay off their balances in full every month are not the ideal customer. They generate limited profit through transaction fees paid by merchants, but those fees are partially offset by rewards programs, fraud protection, and operational costs. From a profitability standpoint, these users are inefficient. The real value lies in customers who carry balances month after month, paying interest that compounds relentlessly. Interest on credit cards operates in a way that quietly magnifies debt. A balance carried forward accrues interest daily, not monthly, which means even short delays in repayment increase the total owed. When payments are made, they are often applied first to interest rather than principal, slowing progress and extending the life of the debt. This structure ensures that small balances can linger for years, generating far more revenue than the original purchase ever represented. Risk-based pricing plays a central role in this system. Banks evaluate borrowers using income, credit history, existing debt, and behavioral data to determine how likely they are to default. Higher-risk borrowers are charged higher interest rates to offset potential losses. Lower-risk borrowers receive better rates, not as a reward, but because they are statistically more reliable. This creates a feedback loop where those with fewer resources pay more for access to money, while those with substantial assets pay less. This dynamic explains why wealthy individuals experience borrowing very differently. Their access to capital is not constrained by high interest or punitive terms because they represent minimal risk to lenders. They have assets that can be pledged, diversified income streams, and long histories of repayment. As a result, banks compete to lend to them, offering favorable rates and flexible structures. Debt becomes a tool rather than a burden. One of the most striking contrasts lies in how debt is used across financial classes. For many people, debt is consumed. It funds lifestyle, fills income gaps, and supports spending that does not generate future value. Interest becomes a tax on past decisions, slowly draining cash flow. For the wealthy, debt is often strategic. It is used to access liquidity without selling appreciating assets, allowing investments to continue growing while borrowed funds are deployed elsewhere. Borrowing against assets illustrates this difference clearly. When assets are used as collateral, the lender's risk drops dramatically, the interest rate falls, and the loan becomes a mechanism for leverage rather than survival. This approach allows assets to compound while borrowed money solves immediate needs. The cost of borrowing is outweighed by the growth of underlying investments, turning debt into a net positive rather than a liability. Credit cards sit at the opposite end of this spectrum. They offer no collateral, no tax advantages, and no productive upside. Their design relies on convenience, emotional spending, and delayed consequences. Banks understand that many users underestimate how quickly balances grow and overestimate their ability to pay them down. The product thrives on this gap between intention and reality. Understanding credit cards through this lens reveals their true function. They are not neutral financial tools. They are profit engines built on risk, behavior, and time. The system rewards those who already possess assets and penalizes those who rely on borrowed money for daily life. This reality is not hidden, but it is rarely explained, allowing the structure to operate smoothly while remaining largely unquestioned. Mortgages are often presented as the cornerstone of financial stability, a symbol of adulthood and long-term success. Buying a home is framed as a milestone that proves you are responsible, established, and building wealth. Banks reinforce this narrative relentlessly, wrapping mortgages in language like good debt, forced savings, and the smart way to build equity. What rarely gets discussed is how mortgages are structured to prioritize the bank's profit long before they prioritize your ownership. When you take out a traditional 30-year mortgage, you are not simply borrowing money to buy a house. You are entering into a long-term cash flow agreement where the bank is guaranteed decades of predictable income. The headline price of the home is only the beginning. Over the life of the loan, you will often pay close to double the purchase price once interest is included. That extra money does not buy you more house, more security, or more flexibility. It is the cost of access to capital, and it flows directly to the lender. The most important detail most borrowers overlook is how mortgage payments are structured in the early years. Mortgages are front-loaded with interest. In the first several years, the majority of each payment goes toward interest rather than reducing the principal balance. You might send in thousands of dollars every month and still barely dent the amount you actually owe. This creates the illusion of progress while ownership accumulates slowly. During this period, the bank is recovering its money and locking in profit, while your equity grows at a crawl. This structure is not accidental. It is designed to protect the lender. If you sell the house, refinance, or face financial trouble in the first decade, the bank has already collected most of the interest it expected to earn. You, on the other hand, walk away with little equity despite years of payments. This is why refinancing is so profitable for banks. Each refinance resets the clock, pushing you back to the interest-heavy phase and generating new fees along the way. Homeownership also comes with costs that are rarely emphasized when mortgages are marketed. Property taxes, insurance, maintenance, repairs, and upgrades all fall on the homeowner. The bank earns interest regardless of whether your roof leaks, your furnace breaks, or your property taxes rise. You bear all the operational risk of owning the asset while the bank enjoys steady returns. In many cases, the true cost of ownership far exceeds the monthly mortgage payment people focus on when deciding what they can afford. Despite this, mortgages are aggressively promoted because they are among the most reliable and lucrative products banks offer. A mortgage ties a borrower to the institution for decades. Payments are automated. Defaults are relatively rare, and the collateral is immovable. Even when defaults occur, the bank often recovers much of its value through foreclosure. From a risk-adjusted perspective, mortgages are extremely attractive to lenders. The idea that a home is always a wealth-building asset also deserves scrutiny. While housing prices tend to rise over long periods, they do not grow evenly or predictably. Location, timing, maintenance, and market cycles all matter. Unlike stocks or businesses, homes are undiversified assets. A large portion of a person's net worth becomes tied to a single property in a single market. This concentration increases risk, even if it feels stable on the surface. Banks understand this risk, which is why they protect themselves so carefully through underwriting standards, down payments, and legal structures. Borrowers, meanwhile, often stretch their finances to the limit to qualify, assuming future income growth will solve today's constraints. This leaves them vulnerable to job loss, health issues, or economic downturns, turning what was supposed to be security into a source of stress. The mortgage system works best for those who understand its mechanics and plan accordingly. Without that understanding, it becomes easy to confuse obligation with progress and permanence with safety. The bank's interests are clear and well protected. The borrower's interests depend entirely on awareness, timing, and restraint. Mortgages are not inherently bad, but they are far more complex and asymmetrical than the simple buy a home and build wealth story most people are told. The most powerful advantage banks have over the average person is not hidden fees, complex products, or massive balance sheets. It is the widespread lack of understanding about how money and banking actually work. Financial illiteracy is the quiet force that allows every other mechanism in the system to function smoothly. It is not accidental, and it is not neutral. It shapes behavior, limits choices, and keeps most people operating within a narrow range of financial outcomes for their entire lives. From an early age, most people are taught just enough about money to function, but not enough to question the system. They learn how to earn, spend, and maybe save, but rarely how money is created, how banks generate profit, or how risk is priced. This partial education creates confidence without competence. People feel responsible for their finances, yet they are making decisions without understanding the rules governing those decisions. That gap is where banks thrive. Banking products are intentionally complex. Terms and conditions stretch for pages, filled with legal language that discourages careful reading. Fees are layered, renamed, and embedded in processes that feel routine. Interest calculations are abstracted into monthly payments that obscure total cost. Most people do not ignore this information because they are lazy. They ignore it because the system is designed to overwhelm them. Complexity reduces resistance, and confusion increases compliance. Inflation is a perfect example of how ignorance quietly erodes wealth. People are encouraged to save money in accounts that feel safe, while rarely being reminded that inflation reduces purchasing power over time. A positive interest rate creates the illusion of growth, even when the real value of money is declining. Banks do not need to hide this reality. They simply do not emphasize it. Silence is enough. The same pattern appears in lending. Borrowers focus on approval and affordability rather than structure and lifetime cost. Monthly payments feel manageable, so the loan feels reasonable. Interest rates are compared casually, without fully grasping how small differences compound over decades. By the time the true cost becomes visible, the decision is long locked in. The bank's profit is secured early, while the borrower absorbs the long-term consequences. Financial illiteracy also shapes trust. Banks invest heavily in branding that signals stability, authority, and safety. Marble floors, formal language, and professional attire are not aesthetic choices. They are psychological tools designed to reduce skepticism. When people do not understand a system, they rely on trust. When trust replaces understanding, power shifts entirely to the institution. This does not mean banks are villains operating in secret. They are businesses responding to incentives. Their obligation is to shareholders, not customers. The system rewards profit maximization, not education. An informed customer is harder to monetize. They ask questions, compare options, and avoid unnecessary products. From a business perspective, widespread financial literacy would reduce margins across the industry. Regulation adds another layer to this dynamic. While consumer protections exist, they often increase complexity rather than clarity. Compliance costs are passed on to customers through lower returns and higher fees. Safety nets like deposit insurance reduce fear, but they also reduce pressure on banks to behave conservatively. Risk becomes socialized, while profit remains private. Without understanding this trade-off, most people accept the system as fair by default. The result is a population that blames itself for financial stress without seeing the structural forces at play. People internalize outcomes as personal failure rather than systemic design. They work harder, borrow more, and save inefficiently, believing discipline alone will solve problems rooted in misunderstanding. This self-blame is one of the system's most effective stabilizers. Understanding banking does not require rejecting it. Modern life depends on banks for payments, storage, and access to capital. The shift happens when banks are seen as tools rather than guardians. When their incentives are understood, their products can be evaluated clearly. Knowledge changes posture. Instead of passive participation, there is deliberate engagement. Financial literacy does not eliminate risk or guarantee wealth. It simply restores balance. It allows individuals to see the game they are playing, recognize who benefits from each move, and decide how they want to participate. In a system built on confidence, clarity is the rarest and most valuable asset of all. If this hit close to home and you want more videos that actually help you build a stronger future, tap here and watch the next one. Your future self will thank you.